Welcome back, everyone, to the Risk Intel podcast, powered by SRA, where we share risk intelligence from experts across the banking industry. I'm your host, Ed Vincent, Executive Vice President at SRA. Michael, we've seen some pretty significant market events in the first half of 2023. We've seen wind downs, receivership, asset sales. In the current market, what risk-related activities and actions can banks take to navigate through the turmoil and the regulatory scrutiny and all the various pressures that are coming from investors and customers and regulators alike?
Yeah, what a shock to the banking market, the last 90 days. It's one of the biggest shock events I've seen since before the last recession, and it came on even faster. And so almost all the bank management leadership teams, CEOs and boards are looking at their financial institution and saying, well, could this happen to us? And what do we need to do to prevent it? And, these collapses made some CEOs who a lot of people thought were geniuses not look so smart. So could they make our board look not so smart? Could they make our CEO look not so smart? So, I've had a chance to talk with dozens of CEOs, dozens of chief risk officers across the country. Had a great meeting at KBW and Telluride with 9 bank CEOs where we talked just about this topic and other fintech companies. And here's what I see, happening. And really, in my mind, what you should be looking at your bank, and that is take a step back. It's time to take a fresh look at everything. All the stuff you've done in the past, all your staffing, the way you're structured, it doesn't matter. Step back, have an out-of-body experience and look at your bank organization and say, where is the risk of our organization? Where could we fail? Could we have a liquidity run? So let's identify that and let's figure out how to prevent it. Could we have a capital issue? Could we have charge-offs? And so taking that fresh look. And I think a lot of our bank clients have taken that fresh look. And here's the conclusions that I think a lot of very well-managed bank CEOs have taken. Number one, this could happen to us. And this isn't somebody else's problem. This is our problem. Number two, there's been a lot of headwind on deposits leaving the banking system. Over $1 trillion in deposits have left the banking system in the last year. And every bank has been impacted by that. I would say more than 90% of the banks have been impacted by that. So what are we going to do about it? So what we're going to do about it is go back to the fundamentals. Do we have the right risk people in place? Do we have the right risk systems in place? Let's start there. There's tools in the marketplace. I've mentioned them before. The RMA's risk maturity framework is a good inventory to make sure you got the right infrastructure and systems in place. But you want to make sure you have the right people in place. In a lot of cases, as a CEO, you've moved people into that risk function that weren't ready. It was okay a few years ago. They weren't ready. They can develop. It's not okay now. They need to be ready. So how do you get that person ready? And that means either more really mentoring and development, intense mentoring and develop, and maybe even some oversight with another management team member, or what we're seeing a lot across the organization is that chief risk officer is being replaced and upgraded. There's a lot of searches underway. I hope that's not in your case what's happening, but realize that if, for instance, you weren't looking at liquidity and interest rate risk as part of your risk program, then
that's a gap.
That's a gap.
That's
You got to close. that gap. And here's a few other things that really smart people are doing in the risk space. Continuous monitoring of risk. And you can no longer wait to the end of the quarter and say, how are our metrics, our risk metrics looking? Because your bank is out of business at the end of the quarter. Silicon Valley's run was a few weeks. It moves too quickly. So if it's moving too quickly, you can make one of two choices. Do things the way you've always done, quarterly reporting, and cross your fingers and hope, I hope this doesn't happen to me. Or you can start looking at it and say, how can I measure this risk more frequently? And it's usually done not by a series of qualitative assessments, but data. Data can come daily. Bring that data together, analyze that data, set those limits. If you're not moving to continuous monitoring of your risk, or even I would say continuous might even be from monthly, quarterly to monthly. I mean, I would feel better at least once a month knowing, if something happens, I'm not 2 months removed from it happening and catching it. So, are there some things you can monitor on a weekly basis or even a daily basis? In the cybersecurity areas, they monitor transactions daily. New people or enhanced skill sets, better training of your staff. Do you have the right risk staff? We talked about that in an earlier program, but evaluate and make sure you have the right staff. Talk to your CEO, talk to your board. Here's the staff I have. Here's the staff I need. Is your risk management program relevant? And I would say most risk management programs are not relevant to the bank's success. A lot of them were developed to take care of the regulators or have the appearance that, hey, our bank has a risk function. No, you're going to have to make it relevant. How do you make it relevant? You're connected to your strategic planning process. If your chief risk officer doesn't understand your strategic plan and goals and isn't evaluating that for risk, it's not relevant. If they're not continuously monitoring a key risk, it's not relevant. If they're understaffed, they're not relevant. How do you make your risk organization relevant? You're going to have to take a, and in some cases, there's very top-end relevant risk organizations around the banking industry, lots of them. So there's models that you can follow. Look at those models, number one. Number two, step back and ask the hard questions. If you don't do it at this time with this level of change in the industry, then you're reacting for an event that you're not going to be ready for.
So taking a fresh look at risk there, critically important. People, process, technology, right? Making sure you've got the right level of people. They have the ability to operate within the organization. And then you have the technology that underpins it, right? The data that you talked about there, being able to normalize, aggregate, pull that together and evaluate it. The other thought that comes to mind as you shared your thoughts there was getting those mundane tasks off of that risk team's plate so that they can evaluate risk, right? They shouldn't be in the business of pulling together data that could be pulled together in an automated fashion, because there's too much work that needs to be done evaluating and analyzing that. So really leading into that people, process, and technology to allow you to take a fresh look at risk.
And one other thing that came to me, Ed, while you were mentioning that is strategy and risk are two sides of the same coin. And you have to think more strategically and analytically as a chief risk officer. And I'm not saying that the department level risk and control self-assessments are not value added. There are some value to them, but I see a lot of my folks putting 90% of their effort into doing risk and control self-assessments once a year and missing the big picture of monitoring what's going on in the business today and thinking about it strategically. What could go wrong? How can we prevent it? How, if it's on my head to save the bank, what can I do to prevent that next bad step?
Thanks, Michael. Certainly very, very timely and very topical. Thank you very much.